I'm speaking with Michael Schueller, Senior Portfolio Manager, Allspring Global Investments, all the way from Milwaukee. So first up, Michael, thank you very much for making the trip and participating in the Inside Network's Income and Defensive Assets Symposium.
Thank you very much for having me. Happy to be here.
Great pleasure. Easy question first up, Michael. What are the key drivers of performance in global credit portfolios today?
Well, we think there are a couple of key issues. The first is the direction of central bank policy. We think that's going to be influenced to a large degree by what happens with inflation. Our view, though, is that we do think there will be a bias for central banks to cut. And so we think a certain amount of duration exposure is important for investors. However, we do have some concerns about fiscal sustainability among various developed market global government bonds. So we do think that investors should focus on that sort of intermediate part of the curve. The other area that we think merits watching is the upheaval, really, of the global trade order that's been in place since World War II. It's not clear to us exactly how that's going to play out, and yet we see credit valuations that are approaching the richest that they've been in history. So we think that's going to be a key issue, and how the changes in the trade order will impact global growth and therefore credit valuations.
How do you incorporate both developed and emerging market credit into your strategy? Is emerging market something that waxes and wanes in terms of relevance, and if so, is it coming back to the fore in present times?
It does indeed wax and wane, and our philosophy is that we want to pull as many levers as we can in building client portfolios, and emerging markets are an important piece of that. At the moment, we have about a neutral weight to emerging markets. They've had great performance this year in part because of the currency tailwinds. However, we do think valuations are a little bit closer toward the rich end. So we do have exposure. We find the diversification benefits really important and useful for our clients, but we have room to add should we see any dislocations in those markets.
How do you assess the trade-off between income generation and increased credit risk?
Yeah, that's sort of tricky in the current environment. We're really focused on trying to harvest as much high-quality income as we can. So we have invested in global government bonds, again, closer toward the front end of the curve. Another area we like are agency mortgage-backed securities in the U.S. We're somewhat cautious with respect to credit because we think valuations are rich. We're generally constructive on the outlook. We do see some slowing growth globally, but we think we're going to avoid a recession. So that's generally positive for risk markets or credit markets. However, with valuations where they are, we think markets are discounting almost a 0% probability of anything negative happening. So we're generally underweight credit risk, waiting for a better entry point.
What role do hybrid securities and structured instruments play in portfolio performance and resilience?
So again, we like to pull multiple levers. We think fixed income markets have a lot of inherent inefficiencies, but they don't persist, and these risks do wax and wane. Hybrid securities are an area we do generally like. They give us an opportunity to play in the lower parts of cap structures of higher quality issuers. So it gives us the opportunity to add a little bit of yield while still protecting the downside. With respect to securitized markets, there are a wide range of risk exposures that one can get from agency mortgage-backed securities, which are very high quality with that government guarantee from the United States. But there are also asset-backed security sectors. Some of them are the kinds that you would expect, credit cards and auto loans and those sorts of things, but other esoteric areas as well that we think offer the opportunity to add some incremental income to portfolios and increase diversification.
What about short duration, say up to 3 years, and then longer duration? Are they different animals? Do you have different teams assessing those parts of the market?
Well, on our team, we handle the entire curve within our team, and we really do pay attention to what we think is the most attractive portion of the curve. So for the moment, we really think that that sort of 2.5 to 5 year portion of the curve is really attractive. As we said, we do expect a cutting bias or an easing bias among central banks. And so we think that portion of the curve gives us some exposure should that happen. However, we do have some concerns about fiscal sustainability longer term. Inflation is certainly higher. It's come down, but it remains higher than it has been since the global financial crisis. And so we think that merits a higher term premium. In other words, we think investors should and will expect to be paid a little bit more to take that duration risk for longer periods of time. So we're minimizing our exposure to that portion of the curve.
How nimble do you have to be in adjusting your positioning in response to changing interest rate expectations? I imagine you can set what you feel will be the strategy, but you've got to retain quite a bit of flexibility.
That's exactly correct. We are quite nimble. And I would note, however, that duration is a really powerful lever. We don't tend to make big duration bets. We do make small duration bets in reaction to our assessment of market conditions and what we think will happen over the course of the next 6 months. That last point is really key. This is how we think about markets. We try to focus on just the next 6 months. That helps us limit the number of variables we have to consider and get right. So when we combine that with the bet sizes, which tend to be on the smaller size, we think that's the best way to approach duration, to provide some ballast to our investors, but also give us the opportunity to tactically position to take advantage of what we think are opportunities within government securities markets.
Michael Schueller from Allspring Global Investments, all the way from Milwaukee. Absolute pleasure to host you here in Australia at the Inside Networks Income and Defensive Assets Symposium.
Thank you very much, James.